This is level 1 of the CFA program, the topic on portfolio management and the reading on portfolio management and overview. This reading truly serves as an introduction to the portfolio management topic. What I like most about it is that it is simple. I also like that it serves as a terrific foundation for material that we're going to cover in level 2 and especially level 3. Now, immediately after this slide deck, we're going to cover 2 readings. They're called Risk and Return Part 1 and Risk and Return Part 2. And we're going to be challenged computationally in both of those readings. But what I want you to do is focus during the next 30 minutes or so on the overview and a foundation, because we need to have this kind of global viewpoint about risk and return before we can actually compute risk and return. Let me show you what I mean here. So notice that each of these action words is described. So we're going to talk about approaches to investing. We're going to talk about different types of investors, individuals and institutions. And notice there are some pension funds, pension plans discussed in that middle LOS. And then we'll talk about mutual funds at the end. And so only a handful of LOSs, and I promise you that you probably know a lot of this stuff. All right, portfolio approach. Boy, do we want all of our chickens and our eggs into one basket, or do we want to chop them into individuals? And I went to the 15 multiple choice questions at the end of this reading, and the first 2 are super simple, and the answers have to do with risk reduction. And so this is what you know. I tell my students this all the time, and I'm quoting myself in class. I say, look, even your little brother or your little sister knows that diversification reduces risk. This is a well-known fact. Now, what we're going to do in the next 2 slide decks is we're going to show this mathematically, exactly how diversification reduces risk. But of course, we don't want all of our eggs into one basket. Now, here's where this first simple LOS gets really interesting. I want you to focus on that illustration there on the bottom right. Notice that on the vertical axis, we have portfolio risk, and we'll learn as we move through this that portfolio risk is going to be measured by standard deviation. And on the horizontal axis, we have number of assets in a portfolio. And so at the origin, we start with, let's say, just 1 share of stock, and then we add a second company and a 5th company and a 10th and a 20th. And so I want you to focus on that green line. And when I was in graduate school, there was a study that was published in one of the top finance journals that showed that the average standard deviation now remember, this is 1988 or 89, somewhere around there. The average return in the stock market and the average standard deviation in the stock market. And the stock market consisted of the New York Stock Exchange, the American Stock Exchange, and the NASDAQ Exchange back in those days. The average standard deviation was about 50%. So I want you to just visualize that with 1 share of stock, on average, that you're exposed to a 50% standard deviation. So that's super high portfolio risk. But then what happens as you add the 3rd and the 5th and the 10th? Notice that green line is downward sloping. I'm sorry, I misspoke there. The green curve is downward sloping. It is not a line. And so that downward slope represents the benefits of diversification. Now notice the green line never crosses the horizontal axis. If it did, then we could say something like, hey, you can buy 41 or 82 stocks and have 0 standard deviation, 0 portfolio risk, which we all know that is not possible. So notice that what happens is that green curve has a steeper downward slope. But as we add more and more assets to the portfolio, that slope becomes less and less steep until eventually it becomes parallel to the horizontal axis. That downward slope is the benefit of diversification. Now, this is what we know. We know that we can divide portfolio risk which we'll learn as we get into the next two readings, we're going to call that total risk. We can divide that into two components. We can divide it into what's called systematic risk, and we can divide it into what's called unsystematic risk. Aren't academics super clever? I want you to think about this. You ready? Let me give you a definition for systematic risk. It's the variability in asset returns due to changes in economic factors. Of course, things like inflation, things like price of oil, things like GDP, things like housing starts, all those macroeconomic variables. So that's one component of total risk. The other component of total risk is known as unsystematic risk. The reading refers to it as specific risk. Let me give you a definition for that. Ready? It's the variability in asset returns due to firm-specific factors. Firm-specific factors include things like operating cash flows, return on equity, quality of corporate governance, the skill set of the executives and the board of directors, dividends, mergers, acquisitions, all that kind of stuff. So I want you to think about this, that we've got total risk, portfolio risk on the vertical axis. And we can chop that into two components. Systematic risk, and I want you to think of that as the risk of the economic system. And then we have unique or firm-specific risk. And so this is what we say. You ready for this? That because that green curve is downward sloping, what happens is that total risk is reduced, but it has no impact on systematic risk. So there's a great line to remember for the exam. Diversification has no impact on systematic risk. So think about this. When you own a well-diversified portfolio, what you're doing is you're essentially betting on the economy. You're betting that the economy will expand. And then you're betting that the firms, that the companies inside of your portfolio are going to be positioned in the right industries so that they can capture the increase in positive net present value projects that results from a growing economy. So let me repeat that. Diversification has no impact on systematic risk. What it does, diversification, and this is what we say in the academic world, we say diversification virtually eliminates unsystematic or specific risks. So what does that mean? That means that when you own a well-diversified portfolio, the only thing that you really care about is the entire economy. Now, of course, as good financial analysts and as good wealth managers, it's our responsibility to identify those industries and those individual companies that are better positioned to experience greater capital gains during those stock market expansions. So we worry more about the entire economy. We worry more about the industries in which our companies operate than we do about the individual performance of the stocks in our portfolio. Now, of course, we're going to learn mathematically in future slide decks how exactly that works. And it has mostly to do with something known as the correlation coefficient. And that's going to be a super fun conversation that we have. So notice the bottom bullet point. An investor who holds a well-diversified portfolio only has to worry about systematic risk. Now, in this reading, there's a period at the end of that sentence, and I'm going to leave that period at the end of that sentence. But in future readings, we're going to turn that period into a comma. And the next part of the sentence is going to sound something like, as long as the measure of systematic risk, which is beta, I'm guessing you guys know that, doesn't change. But let's forget about that. Let's postpone that conversation for another day. Now, this is what I was referring to in my introduction. Let's look at this LOS. Describe the steps in the portfolio management process. This is going to be important here in this slide deck. It's going to be important in level 2, and it's going to be really important in level 3 when we get to the exam and the institute says, here's a client, here's a description of the client's risk and return, here's $10 million, do something with it. So we need to know intimately the steps in the portfolio management process. All right, so here they are: planning, execution, and feedback. So let's start with planning. What do we need to do? Of course, as good wealth managers, we have clients come into our office, either physically or virtually after COVID. And what do? We look at the clients and we say something like, all right, what are you worried about? What are your aspirations? What are you hoping for during the course of your life? All right, so boy, we have to establish the client's risk and return objectives and their constraints. This is a guaranteed question in level 3. You'll have a client, you'll have to come up with those risk and return objectives and the constraints. And there are 5 or 6 constraints depending on how you classify those. What does the client want? So here's what I tell my students. I say, look, when you become good wealth managers, you are going to know your clients better from a financial perspective than they know themselves. And it's your responsibility to understand the client's needs. And the only way that you can do that is by interviewing the client and figuring out what they aspire to and what they fear during the course of their life. And of course, those objectives and constraints include things like, hey, paying for a child's wedding, paying for children's college education, putting a down payment on a lake house or a beach house. My father was always worried about how much he was going to leave to my sister and me. And we would always say to him, we would say, hey, dude, what are you worried about? We both have pretty good jobs. We don't need your money. And he would say, no. My dad, when he died, he left me this money and it was important. And I want to leave you guys a lot of money. And now, of course, my father was an educator in a private school, so he didn't die with millions of dollars. But I mention that is that some clients have this bequest function. So if a client says, boy, I want to leave my children this and this and this, then we need to be sensitive as good wealth managers to what the client needs. Now, a component of understanding the client's needs is the educational process. I always tell my students about the example of an individual who was extremely wealthy, had no spouse, had no children, and this client wanted to leave her entire wealth to her cat. And it was hundreds of millions of dollars. And so, boy, it'd be awesome if you guys have clients like that someday. But really, you need to educate the client and say something like, what does Fluffy really need? All right, so Fluffy needs let's buy Fluffy a golden bed, right? And hire a round-the-clock person to attend to Fluffy's needs. So what does that cost? Maybe that's $1 million. Let's take the other $99 million and let's think about donating it to the National Cat Foundation or. And so the educational process then is super important about understanding the client's needs. Now, of course, you can't force the client to say, look, Fluffy doesn't need any of this stuff. You need to do this and this and this. Remember, the client comes first. So let's prepare the IPS. I make my students in the investments class do this every semester. And so what this is the document that describes the relationship between the client and the wealth manager. And it includes all different sorts of fun things like the risk and return objectives, all of the constraints, and a timeline and the planning process and all of this stuff. Of course, we're going to put this in writing, and there's probably some kind of a system inside of the IPS that says, all right, here's our current state, but let's make sure that we revisit this every year, probably on an annual basis, or if something else happens, like the birth of a child or the death of a parent, or, hey, we wanted a lake house that was this big, now we want a lake house that is this big. And so this is really the global lens through which the CFA Institute has crafted the entire CFA program. It's really a design of teaching us how to write an efficient and an effective policy statement, not just for individual clients, but for institutional clients. And everything that we talk about, everything that we study in level 1, level 2, and level 3 could theoretically be thrown into a policy statement. It's probably not going to be, but it could be. All right, so what did I say originally? So the client comes into our office. We get to know everything from a financial standpoint about the client. And then the client says to us, hey, here's $10 million. So they say, we have an investable asset base. So it's our job to decide what to do with that. So what are we going to do? We're going to, of course, probably have a money market mutual fund so they have access to liquidity. We're probably going to invest in fixed income securities. We're probably going to invest in shares of stock, right? Those are the traditional asset allocation outlets. But boy, what have we learned so far? We know in level 1, there's an entire reading on alternative investments. And we talk at length about this in level 2 and in level 3. So maybe we're going to invest in an apartment building, maybe a piece of land. Maybe we're going to buy a lot on Lake Norman in North Carolina and just hold on to it because maybe we spend $300,000 on the lot today. Maybe in 10 years it'll be worth $1 million. What we need to do then is break this into asset allocation. So think about it just this way historically, bonds, stocks, and alternatives, right? And then we have to decide what is our weight. Are we going to say equal weighting? That's probably not too efficient, but maybe we'll use some software to come up with optimal allocations between and among all of those different stocks and bonds and individual alternatives. Then what we need to do is we need to say, okay, we're going to buy stocks. Let's suppose we're going to buy 31 different companies. Well, then we need to go and evaluate and find those 31 best companies. If we want to do alternative investments, and maybe the client wants to invest in art, well, we need to become art experts. Do we want, and I don't know anything about art, do we want a Monet? Don't they cost 10 million or 20 million or 100 million? Or do we want, something that's drawn by somebody that goes to the arts festivals throughout the country? We need to figure all that stuff out. But what we want to do is we want to try to identify securities that are undervalued, whether it's a bond or a share of stock or an apartment building, and I use this example regularly in my classes. Years ago, I was just wasting time on eBay, and I came across the bathing suit that Daniel Craig wore in the great James Bond movie Casino Royale. And it was on eBay for $18,000. And there were like 100 different bids. And I thought to myself, you know what, this is really cool. It's an investment. So we buy this movie memorabilia for $18,000. Now this was, 10 or 12 years ago. And who knows how much that bathing suit is worth now that Daniel Craig is no longer doing James Bond movies. And here, spoiler alert, those of you who haven't seen the new James Bond movie, cover your ears. James Bond dies in the last movie. Oh my gosh, I was so sad. So security analysis, trying to find undervalued securities. And then we put them all into a portfolio. Now, what did we say just in one of those previous slides? We know that we're going to diversify across asset classes and within asset classes. And so that's why we have diversified portfolio can be constructed. So think about this. The client comes to our office. We learn about the client. Then they throw a bunch of money at us and we allocate, we analyze, and we construct. And then what we need to do is we need to make sure that we're on top of it, right? We need to say, okay, we've done this, we've done our homework, and we've constructed this portfolio that is the appropriate portfolio for you, Mr. and or Mrs. Client, today, but what happens in the future? So we need to rebalance, we need to monitor, and then we need to figure out how we're doing. Let's suppose that you come to me with $10 million and you say, hey, Jim, my return objective is 10%. And that includes inflation, by the way. So I do all this stuff that we were just describing in the execution step. And after the first year, I've generated a 10% return. Are you happy with that? Well, that's what you demanded. That's what I delivered. So you ought to be satisfied. But what if the S&P 500 index delivered 20% that year? And what if the wealth managers of all of your neighbors earned 22% and 25%? Well, you're not going to be very happy with my performance. So notice that second bullet point over on the right. Performance must be measured against a benchmark. All right, categories of investors. I'm guessing that you candidates know this. So individual investors. You're going to have all sorts of different clients come into your office, and some of them are going to be ultra high net worth, some of them are going to be high net worth, and most of them are probably going to be just regular old people, who've worked really hard and they saved some money, maybe they've inherited some money, and they have short-term goals and they have long-term goals. And so this is what I was suggesting earlier, that you'll ask them a whole series of questions. What are your dependents, your children, maybe your parents? Are your parents getting older? Do they need to be taken care of? If you already own your home and you already own a second home and your children have already been educated, how about some philanthropy? What are we going to do? How are we going to handle all of these different kind of goals that are both internal and external? Now, this is where it got super interesting for me when I was going through the CFA program, because I was fairly well versed in handling individual clients, but the CFA Institute is really big on institutional clients. And this is where I had to do a substantial amount of studying, 20 years or so ago when I went through the program. All right, so institutional investors include banks. So what does a bank do? Excuse me. What does a bank do? Essentially, a bank accepts deposits, right? And that's the liability, and it makes loans. And those are the assets. And so notice there's a natural mismatch there. Those deposits that are coming in, they have maturities of, let's say 1 second, right? Somebody could come in and deposit the money, and then the next second they could withdraw the money because it's their money. I always give my students the example. You guys who are watching my videos know, and including this one here, my James Bond references in one of those pretty relatively average James Bond movies where Bond goes into the casino and he has a big silver case of money and he deposits. I think it's $4 billion. And then he goes and plays and he wins some money, and then the next day he goes and withdraws it, and nobody's happy about that. So see the mismatch between, a 5 or a 10-year loan and a liability that matures in, just a few days if you're in a James Bond movie, 2 weeks or months. And so look at the second bullet point, and this is probably the testable question. So banks have reserves that are invested in relatively conservative and very short-term securities so that they can generate interest. But there's the key: maintain liquidity. So any kind of a institutional question that you get on commercial banks, just think about liquidity. Now, insurance companies have an interesting and yet similar kind of a balance sheet. I mean, you think about it. What does an insurance company do? It collects premiums from us, right? We have health insurance premiums, we have car insurance premiums, we have homeowners insurance premiums, we have life insurance premiums, we have property premiums, we have all sorts of this. So what does the insurance company do? So they collect all this, and then they have to invest it because, let's face it, we are not all going to die or have a fire or go to the doctor or have some property damage. We're not going to do all that stuff tomorrow. We're probably not going to do it next week. But over the long term, and this is what makes insurance companies such an interesting animal, is that they hire really smart men and women, probably like you, not me, because I'm not smart enough to be an actuary, but really smart men and women who can predict when that insured pool is going to experience a fire or die or any of those kinds of other things. And so with an insurance company, they do two things. They take some of the premiums. In fact, they take most of the premiums and they put it over here and they put it into stuff that's relatively safe. And then they have a surplus account, which is the account where we can really excel. We can use our wealth management and CFA skill set to maximize the surplus account over time. So what does an insurance company want? They want to have, this general account, this in-house portfolio management strategy that is able to provide for all of the claims that it needs to make over time. And remember, the insurance company is going to be pretty well versed in the timing of those claims, maybe a little bit less well versed in the total damage, but maybe what their liability is. So, those are two kind of complementary questions. I'm fascinated by insurance companies these days with homeowner policies on the east and west coast of the United States, because more people are building, and that means that there are more total damage when a hurricane or a flood comes. And so insurance companies are really trying to manage that from the coastal perspective. Endowments and foundations, these are generally nonprofit institutions. Of course, I work at a college, and we have an endowment, and our endowment goes to scholarships. And so most colleges do this. They have an endowment fund, and so that endowment fund is invested in all sorts of financial securities, and we receive interest and we receive dividend payments, and so we take that and we help students pay for their college education. So that's an endowment. Now foundations, these are very similar, but they're probably unique to a specific kind of a goal. Like what did I say earlier? I mean, there could be a cat foundation out there that helps. Maybe it makes money available to vets who are going to make sure that we don't have tons and tons of cats out there. It's my understanding that you can have a cat operation so that they don't have little kittens. So maybe that's the foundation. And so that individual from my previous example, boy, it might make sense for that individual to donate some money to that foundation. Now, what we do know, especially those of you who follow this from, I have a small institution, but, you hear about Harvard and Yale and their endowments, which are huge amounts. But this is what we know, that their asset allocations have super high proportions in alternative investments. In fact, I did some searching relatively recently for a project that I've been working on at school, and that many endowments and foundations have allocated over a third of their portfolio to alternative investments, mainly into hedge funds and to private equity. Look at the bottom arrow point there. So this is probably a good testable question. Maintaining inflation-adjusted capital while generating income. All right, so what we want to do is make sure that we keep pace with inflation. That makes perfect sense. But then we have these objectives, so whether it's, helping a cat through an operation or funding scholarships to whatever types of students. And these can be, fairly narrow. An endowment a college could receive a contribution, and the donor might say something like, look, I want you to take this money and invest it in high dividend paying stocks, and whatever dividends come in, I want you to provide a $5,000 scholarship to a student who is interested in graphic design, but specifically I want to help a student learn how to draw video game characters. Hey, boy, that's really, really narrow. So you got to imagine, how are we going to manage that type of an investment? Oh, sovereign wealth funds. Those of you who are paying attention to the golfing industry would know that there's a sovereign wealth fund out there that has substantially changed the landscape of professional golf. But notice what that first bullet point says there. Government-owned investment funds that can be invested in virtually anything. How about pension funds here? So we've got a couple of these, right? A defined benefit pension plan. These are the pension plans that you read about in the financial press, because these plans say something like, okay, you come to work for us and you work for us for, let's say, 30 years and you retire, what we'll do is we will guarantee that during your remaining life, we'll pay you based on some formula, of course, based on your salary and maybe your contribution. And so what this means is that as a pension fund manager, we know exactly what we're going to have to pay each employee when they retire and then when they live. So boy, this is really interesting. As a pension fund manager, as a good wealth manager, we need to match the fund's assets and their liabilities. And so typically we're probably going to invest in fixed income securities. We're probably going to match duration. Boy, there's a concept that we'll talk about at some time in the future. And so think about this. Ideally, if I'm the pension fund manager and you guys are all of my retired employees, and I want to invest in fixed income securities that pay me, let's suppose they pay me $100 in a coupon payment this month. Well, it would be awesome if I paid one of you $8 and one of you $16 and one of you $22, if they all added up to $100. So my cash inflow from the fixed income security matched my cash outflow to your retirement income that you are legally due by your employer. Now, it gets complex because this employer has workers who are 20 years old and 30 years old that are not going to retire for hundreds of years, probably not hundreds of years, but at least tens of years. And so that gives me a little bit more leeway. I can take some of these contributions and invest them into riskier securities because those 20-year-olds, they're not going to demand an income until they retire when they're, 67 or whatever age that's going to be. Now, the defined contribution plan, on the other hand, is a plan in which the employee contributes, and maybe the employer matches that, but the pension fund manager has almost no obligation. In fact, I'll say zero obligation during retirement. And that's what I have at my college. I contribute 1% of my salary. The college contributes the same amount, and then that will grow over time. And of course, during the COVID hit, my pension plan lost hundreds of thousands of dollars. And then during the inflation of 2022, same kind of thing. But that's on me because I got to pick. I am the employee and I got to pick where that money was invested. And so make sure you know the difference between defined contribution and defined benefit. So here are a couple of slides here that illustrate these differences here. So let me go ahead and just read these. And these are summary statements of what I said. The defined contribution plan, the contributions are defined, but the benefits are not. Right? When I retire, I'm now 60. When I retire, when I'm 80, because I love teaching, what happens if the day before I retire, we have a massive stock and bond market crash so that the S&P 500 index is now zero? So my portfolio balance will be zero. And so I'll say to myself, boy, I guess I'm not retiring when I'm 80. So what's the objective? Accumulate wealth by investing a portion of wages while working. Yeah, that makes perfect sense. Yes, the employee assumes the investment risk. So that's another thing to remember. On the other hand, for the defined benefit plan, it's the pension fund manager, it's the employer that assumes all of that risk. And so let me just go through these quickly. Look at the last one here. The payout is usually based on salary and number of years work. So that's the formula that I was talking about earlier. We need to worry about the timing of those future liabilities and those cash flows. That's what I was saying about the $100 coming in and the $100 going out. How about this simple LOS? Describe aspects of the asset management industry. Well, let's go ahead and state the obvious, right? Consists of firms that manage assets on behalf of their clients. And so these clients can be institutions or they can be individuals. The asset manager can be on the buy side. They can be on the sell side. I'm guessing you guys know all this stuff. Here's a great question that I ask my students all the time. Do you want to be average or do you want to be by definition, either above or below average. And the students always say something like, oh, well, I'm above average, so I want to be above average. Why would I want to just be average? Well, so that's passive management. And, the dude who created Vanguard faced the same prospect in, when was the Vanguard 500 Index Fund created? 1970, somewhere around there. And this guy said, here, send us all your money and we'll invest in the S&P 500 index. And he was criticized because people said, well, why would you just want to earn the market return? Don't you want to beat the market return? And of course, he was pretty smart. And he said, well, let's let the individual investors out there figure it out. And of course, the Vanguard 500 Index Fund, which was, let's say it was this big back in 1970, it's now this massive thing. So passive investing is appropriate for lots and lots of investors who just want to earn whatever the market is. And the market a lot of times is the S&P 500 index, although it could be almost any index. Now, active managers, this is a completely different idea. This is where we're going to say something like, hey, we know there's public information out there, and we know that the markets are not perfectly efficient. Let me speak parenthetically here, right? So we're going to have a great conversation about the efficiency of markets and rational investors and behavioral investors. And so what active managers are doing is they're saying something like, hey, look, we believe that the market is pretty efficient. That's my term. That's Jim's term. Pretty efficient. But there are pockets of inefficiencies out there that we can take advantage of because of our ability to perform fundamental analysis, which is pretty much the basic foundation of the CFA program, or technical analysis, which is the process of using historical returns or historical volatility or historical volume to put together some kind of an investment strategy. And so we can use fundamental or technical analysis to beat the market. And that's what active managers seek to do. Outperform a specific benchmark. Now, traditional asset managers, of course, this is what I was talking about earlier. They invest in fixed income securities or shares of stock or long only. They can try to generate income. They can try to generate income for themselves through the fees that they charge through their management of all of these assets, or they can have, there is another group of alternative asset managers which focus on hedge funds and private equity. We said that before, right? Or venture capital or other alternative investments. And what those alternative asset managers do, then they get their income from management fees and from performance fees. This becomes an important topic before usually presidential elections, when someone will bring up the topic of carried interest, and then some people will say, oh my gosh, carried interest, boy, that's really not a good thing. And others will say, boy, it makes perfect sense. Growth in passive investing is fueled by the low cost. Yeah, this makes perfect sense. That if the passive manager is just taking our capital and investing it in the S&P 500 index, well, this is done by an algorithm, and it doesn't really take a whole lot of time. And so, boy, there's probably low costs, low total costs, and low marginal costs associated with that. But then again, there is this this sense over the last, let's say 10 years, and probably goes back even longer than that, that institutions are collecting data, and they have all of this data. And so historically, they've collected data on things like, okay, how much did a client who has 1 million to 3 million of investable assets, how much did they allocate to private equity? And so they collect all this data. But big data extends to not only include like the traditional methods of categorizing and classifying clients, but also to things like, hey, where does my client travel during the course of the day, and I'm going to use the GPS in his or her phone to see if the client goes from here to there. And let me just come up with an example. Does the client go from here to there and stop at Walmart 3 times a week? Well, if I have 1,000 clients and 80% of them are stopping at Walmart on the way to work, boy, that means that maybe I ought to think about investing in Walmart. And so this big data has such a huge possibility for wealth management. And then we know that there are really, really smart men and women out there who can put together investment algorithms that have tremendous value. I have a friend who I went to graduate school with who works for one of the huge wealth management firms. In fact, he would say it's the biggest one. And he says regularly to me, he says, you know what, I wish I could share with you the asset allocation, the efficient allocation of individual stocks and fixed income securities and all these sorts of algorithms. But they're proprietary, of course, robo-advisors. And he said they're just so awesome. And I'm guessing that you guys know way more about this than I do. And so we can use this asset allocation, investment planning, investment strategy selection by using the help of, and let me just go back here, big data, using the help of our assessment of client risk and return objective so that we can automatically come up with a reasonable and efficient solution. How about mutual funds? I'm guessing I don't need to tell you any of this stuff. Why are they so popular? Diversification, professional management, and of course you can get into one of these things for, $3,000 or so. Or if you decide to invest $100 a month, then these mutual funds will take your capital. What do? They aggregate or they pool all the funds, and then they go out and they buy shares of stock or bonds. Of course, some of them can be passive, so they're just going to mimic the return of an index, or many of these are actively managed funds, so they're trying to outperform a benchmark. Difference between open-ended and closed-ended mutual funds. Let me give you my quick definition here. If I'm an open-ended mutual fund manager, I say, hey, send me your money today, send it to me tomorrow, send it to me next week, next month, whenever you want to send me a bunch of money, I'm happy to take it. And if you want your money back or part of your money back, just let me know. I'll send it to you tomorrow or next week. Or next year or in 10 years, So it's open-ended. It means that funds flow in and out regularly. How do we value these things? Well, what we do is we take the portfolio value. We take the value of stock 1 and 2 and 10 and 50 and 100 and bond 1 and 2 and 10 and 50 and 100. And we sum those positions, and then we divide by the number of outstanding shares that I distribute to you guys as my shareholders. And we take a ratio and we get something called the net asset value. I always tell my students, and I say, don't ever tell the other finance professors this. So you guys do the same thing. Don't tell your finance professors this at all. But I tell my students, just think of net asset value as a price of the portfolio. Now, closed-end mutual funds, if I'm a closed-end mutual fund, and this is how it has worked historically, not necessarily, but I will say something like, look, send me your money today, send it to me tomorrow, but you better hurry up, because you need to send it to me in the next 60 days, because after 60 days, I'm closing down the fund. So I accept your money, and I'll probably say something like, you know what, if you want your money back in the next 60 days, I'll give it to you, but I'm only going to give you half. Well, probably not half, but maybe something more. All right, so what happens then is the fund gets closed to new investors. What that means then is that somebody on the floor of the New York Stock Exchange or in the over-the-counter market is going to have to come to me and say, all right, we want your fund to trade on an exchange, and so then we have some kind of an agreement. We'll talk about that in another reading, but they are closed to new investors, which means that they're going to have a net asset value and and they're going to have a price on the floor of the New York Stock Exchange, and those prices are probably going to, I'm sorry, the net asset value and the price of the closed-end mutual fund on the exchange is probably going to be different. Boy, I've said this. So we have money market mutual funds. I bet you know about that. Bond mutual funds, stock mutual funds, and then we can have hybrid or balanced funds. And this is pretty much what you get when you go to an investment banking firm's webpage, and they allow you to do some kind of an anonymous survey, and they have like a target. You know, if you're gonna retire in, let's say, 30 years, well, then they say, oh, then you should have 70% equity and 30% fixed income, and so that's a hybrid fund. Exchange traded funds, these are interesting animals that, you know, don't have a long history. Mutual funds go back to, you know, the 1970s. Exchange traded funds, these go back, you know, maybe 20 years or so after that. But these work very similarly. If I'm if I want to form a portfolio of well-diversified shares of stock, what I can do is I can create an ETF, an exchange-traded fund. And so it's basically, look at that first point, it's basically an index fund. It trades like a closed-end fund. But what's really cool about these ETFs, and I'm guessing that you know this, is that we can have these based on almost anything. We can have an ETF based on the S&P 500 index. This is known as a SPDR. This was the first one, and these have super low management fees, and that's why they're so popular. There's the diamond that mimics the Dow Jones Industrial Average of 30 stocks, but there could be ETFs for almost anything, and so this is why these are so popular, because I could create Jim's ETF. I probably wouldn't call it Jim's ETF. Maybe I'll call it the horse racing ETF. And what I do is I go and I invest in companies that only are exposed to horse racing, like, you know, Twin Spires or Churchill Downs or Penn National. That way, I might have a portfolio of, let's just say, 37 stocks. And these would probably be global, by the way. You know, 37 stocks that are in the horse racing industry. And that might be super attractive to a whole bunch of investors out there who want specific exposure to the horse racing industry, because they can buy into my ETF for, you know, let's say $100. But they can't buy into a horse for $100. You know, you have to spend at least thousands of dollars on a horse, if not millions of dollars on a horse. And then if you buy the horse, then you have to worry about feeding it. Now, mutual funds tend to invest in just long positions in stocks or bonds, but hedge funds are a completely different animal. And so what did I say earlier? I said, if I'm a mutual fund manager, I say, send me your money and I'm going to invest in stocks and bonds. And that's, you know, inside of the prospectus. And so, you know, I'm legally obligated to invest in just what I tell you that I'm going to invest in. But a hedge fund is really a unique animal in that when I ask you if I'm the hedge fund manager, if I say, send me your money, I don't really have to tell you what I'm going to do with it. I can say something like, I'm going to do whatever I want with it within this range. I'll invest in stocks, but I might take short positions. I might invest in oil, but I might take short positions. I might invest in private equity. I might invest in an apartment building. I might invest in, here's another James Bond reference, the Fabergé egg that was in that great movie that Roger Moore starred in. Now, a hedge fund is really kind of a misnomer because they're really not hedging, but the term hedge fund makes it sound like they know what they're doing in terms of risk management. And that, of course, is true. So notice that second part there of the first teardrop point, engages in more aggressive strategies and positions, which include the whole gamut, the entire spectrum of derivative securities. So hedge funds, they buy options. Hedge funds take positions in swap contracts and futures contracts. And so what they're trying to do is they're seeking positive absolute returns because there's probably really no benchmark out there to compare them. I mean, the S&P 500 index, it makes no sense to use that as a benchmark. Now, there are hedge fund benchmarks out there, of course, but what are these aggressive strategies? Short selling, derivatives, and there's a title of a famous movie from the 1980s. I don't think I've seen that in a long time. Other People's Money with Danny DeVito. I can't even remember it was a good movie or not. So what I'll say is don't watch Other People's Money. Go watch a James Bond movie. Now what I want you to do is take a look at the questions at the end of this reading. They are super simple, and I'm pretty sure that you can get 13 or 14 out of those 15 correct if you do that immediately. And so let me go ahead and just review these. So describe portfolio approach to investing. Describe the steps in the portfolio management process. Those are probably the two big global, big picture, I'm drawing a big picture here, global LOSs that relate not only to this reading, but also level 2 and level 3 material. I would focus on those two globally, and then the second one, those different types of investors. And so I can envision the CFA Institute saying, here's an individual, and here's a bunch of stuff regarding that individual, or here's an institution, here's a bunch of stuff with this institution. What do you think they're most worried about? And the answers could be liquidity, or growth, or value, or preservation of capital. Or I want to buy a beach house in 5 years. Hey, I enjoyed myself here today, so thank you for watching, and good luck studying.